Okay, let's get started. Welcome to our webinar, and thank you for taking the time out of your day to join us. We're happy to partner again with one of our most popular speakers to bring you this webinar today on trade artificial intelligence using option strategies, and this is part one of our two-part series. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, Investrade. A few housekeeping matters. The session today will last approximately 1 hour. We ask that you take a moment to locate the Q&A box on your screen. Please enter all of your questions here throughout the webinar, and our speaker will answer them at the end of his presentation. And to tell you a bit about eOption, we offer you many options for your trading. You can trade stocks, exchange-traded funds, bonds, and mutual funds. And of course, as our name implies, we also offer options trading, and we enjoy teaching people how to trade them. We offer you some of the lowest rates in the country, including zero commission on stock trades and ETFs, and options are just 10 cents per contract plus $1.99 per trade. We also offer an easy-to-use trading platform as well as free trading tools to help you spot option trading opportunities. And also, recording of this video will be available on eOption's YouTube channel tomorrow, along with an extensive library of trading videos. So we encourage you to take a moment and subscribe. And if you go in the chat box, you also see a link. You can just click on that if you'd like to quickly subscribe to eOption's YouTube channel. So if I can turn your attention to the screen, we do have a disclaimer on the page. Option trading does have risks, and we encourage you to take a look at this page that just came back. And if you could go to the fourth bullet point. So options do carry a high level of risk and are not suitable for all investors. And certain requirements must be met to trade options through eOption or Regal Securities or any of its divisions. And there is a booklet called Characteristics and Risks of Standardized Options. And there is a link on the page. You can also contact us at eOption, and we'll be happy to provide you with a copy of that. So I'd like to turn our attention to our speaker now, Teddy Kekstadt. He's done many webinars for us, and we'd like to welcome him back today. Teddy's a professional trader and has over 30 years of trading experience. He's traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years, and has been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked and is the author of the book, High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University in Chicago. So without further ado, I'll turn it over to Teddy Kekstadt. Thank you.
Thank you, Gina, for that introduction, and hello, everybody, and welcome to our webinar today. So get ready of all you bulls and bears out there, and let's get into it. So right now, real quick, to show you, we have the eOption paper trading platform up. This is the same as the regular platform. Obviously, it's a demo account. So, and we have the account summary page here, which shows you obviously the basics like your balance and things like that. And real quick, I just want to show you under tabs the different things you have. You can set alerts. You can there's options play, which is something you can use for running different scenarios. You have a screener. You have the news. You also have your positions and orders, which we're going to be using that tab. We have trading. We have option chains for looking at different pricings, research, charts, you name it. And if you have any questions, you can contact eOption on that. So I'm going to pull up the trading page, okay, because we are going to look at Nvidia first. So our topic today is obviously geared towards stocks that are very, very entrenched in the AI industry. Obviously, we know AI is all over the news. It's to talk about everything. We hear it's embedded in everything from entertainment. We have the writer's strike, which now is an issue. So it's definitely, and if you haven't heard about it, you must have been on a very long, quiet, secluded vacation. So the companies that we're looking at are all tech companies that really are at the front runners of pushing AI. And if whatever they have, they're also the kind of companies that buy up other ones. So we'll be looking at these things and trying to look at different trading opportunities and option strategies that we can apply to them. So Nvidia is our first one. So let's take a look at a chart of Nvidia here. We have Nvidia Corporation. As you can see, obviously, it is trading just below its highs. The stock has gone just from the spring. You can see it was down at 275. It's up almost over $200 a share just in the past few months. Talking like not a bad ride, over 100% return just in less than a quarter of trading. So we're going to look at what we can do here. We have, obviously, you can buy the stock. We're going to also look at different type of options prices. So right now the market is trading at 470.17. So let's put this into our thing here. So right now you can see 100 shares at 470. Now this would be a very, very expensive position here. So if you were going to buy this stock outright and invest it because you're into AI, it's a big amount of money to put up right in front of the highs as well. So not that this market may not go to 800 or 1,000, it very well could be. This could be very low buying opportunity right now. So, but we're going to look at how to take advantage of this. So we know that if we bought the stock right now, the way to look at this is that the market's in a bull trend. Trend is your friend. Being long is what you're looking for. You're looking at upside potential. So now the key also is when you're getting long, what is going to be your risk? Now, if you're long this stock, obviously it's a very expensive stock. If you're, depending on if you're in for a trade or if you're in for the long haul, in this case, we're talking about AI, it would be the long haul. So you could be looking to buy the stock right now here at 470 and get long, or you could also look to get long here and have a plan to scale down or scale up. Obviously, this would take a lot of capital. So what kind of option strategies could we use here? So right now, if you wanted to get long this play, now especially since, think about this, we have the market is near its highs. Interestingly enough, we have an overbought, oversold indicator. Now remember, all indicators are lagging. So this one here has just crossed and giving us a nice little buy signal here on this indicator. So this, when you have a market in an uptrend and you have a signal like this, that typically means there's a lot of strength and buying pressure in this market. So being on the long side or the bullish side is obviously the direction that most of the consensus is right now. So let's look at the pricing. So if we wanted to buy a call right now, one thing we have to look at is what kind of strike price will we look at? Now it's key when you're looking at options to think about your time frame. So in a situation like this, we know the market's on its highs. We're already at the end of October, or excuse me, end of September. We have a holiday market coming up. If you're going to put on any type of option play here, you'd be looking to get somewhere between 25 and 45 days out. And that would also be indicative of the type of spread or option that you would put on. So let's take a look at this. We have this market that has been topping out here, but basically has been in a bull trend. It's been making higher highs and higher lows. That is a sign of a trend. So we know that this last swing low here is pretty much our support base. So any strike price above 400 would be kind of where we're looking to look at. We wouldn't be looking for strike prices above the market, even though they're cheaper. But the fact is we're taking more risk on them. And even if the market does go up, the profit potential is not as strong as it would be if we have an in-the-money option. So let's take a look at the strike price here. So if we're at 470, let's try and find a strike price around 470. So we're going to look up the option ticket right here. So we have NVDA in here. The option, we added the option here. That's our first order part. Action is going to be to buy to open. So we're going to do a one quantity. And remember we said we want to find something that's 25 to 45 days out. So if we go to September 29th or October, that would be pretty much the range that we're looking for on this. So let's take a look at September 29th. And remember, we're looking at the markets trading at right around 470. So even though it's just below that, it's pretty much an at the money. Now, when you're right around the strike price where the market is trading, that's called an at the money. And if it's below, in this case being a long, a call, like for instance, if let's say it was a 450 call, that would be an in the money call because it's already way below the market price. All right, so here we have a 470 call. There we go. So whenever you put an order in, you want to make sure you always check what you're doing. So here we have a buy to open. We're buying the option. Quantity would be 1, September 29th. So that gives us a little over a month. It's more than 25 days. 470 is the strike price in a call. So now this would cost $37.50. So for those of you that are new to options, $37.50 is not $37.50. It would be $3,750. Remember that whenever you have an option quote, you have to multiply times 100. Okay, so for instance, if the option was priced at $1, it's really $100. Okay, just to be clarity on pricing. So if we were to do this one here for Nvidia, we're going to mark this here with a 470 strike. So we'll put this little line here. We'll do a little blue so we know what we're talking about. And we're going to lower this to 470. Okay, so this is our strike price, this little blue line right here. So this is the call that we're looking to purchase. So remember, if we're long and we want to buy this stock, and we have every reason, we have an indicator that's bullish, we have a trend that is bullish, even though we're right below the highs, but it's been holding strong. We have the news, earnings, and other things that also support being long this trade. So here we put the long call, and we put 470 strike, just so you can stick with it here on the video. Okay. All right, so this is our first trade that we place here. So when you do that, you verify it. Here, once again, you check the cost here. It's going to cost $3,730 plus a couple of, these are OCC commission, regular commissions, not for the regular trade. There you go. And you've placed the order, and there it goes verified. So now it's done. This option ticket is cleared. And then if you go back to account summary, wait a minute. That didn't trigger. Let's see what's going on here. There we go. Okay, let's try it again. All right, verify trade. Okay, there we go. Okay, so we have one call that we placed. So now remember, we looked at, you could have bought the stock, but you would have to put out 10 times the amount of money to get long. Now here's the thing is, that option cost a little over $3,000, right? So when if you think about what would happen if you would have bought the stock. So let's say that you had your risk level, which we have here is this last swing low. So if you had a protective stop for your stock order. Okay. So this has you right at say 403. So you have a $67 per share that you would lose if this market fell below $403. If you think about that and the risk you take, and here's the other thing is, what happens if the market was to, let's say, dip down here for just a day or two and then come back up and just keep on going? If you bought the stock and you had the stop in place, you would have spent the $47,000. The market would have came down here, you would have lost the $63 a share, and then all of a sudden the market comes up and you're like, oh my gosh, I wish I would have had a lower stop. Does that mean you shouldn't have a stop in the market? Absolutely not. You should always trade with stops when you have stocks. You should always have an entry price, a risk price, and a target price. With options, though, it gives you the opportunity to forego this little spot here. You don't have to worry about it at all. Right here. This little area here, this whole spot here, you don't have to worry about it when it comes to options. With the stock, you would be out, and then all of a sudden your opportunity cost gets high. It's much harder to replace that money when it comes, as far as when it comes to being profitable, because now you have to recoup your losses before you can go become profitable. With the long call, we have all the way until, remember the expiration date, excuse me, was September 29th of 2023. So you have all the way until this day right here, September. There we go, right there. So we have all the way out to this time for the market to, as long as it gets above 470 with the call, you're going to be fine, because the option will have value. And since if right now the market the trend is your friend, it made a higher move low, Now it's made a higher move high. It's reasonable to say that the market's going to digest a little bit, which is fine. We have plenty of time. And then after it sets a higher move low, then we should see another bounce and hopefully get a higher move high. In which case, since the high is already above our strike price, we'd be looking for the market to get up to, say, 475, 480, 490. In which case, your 470 strike price would be in the money, and you would be up, depending on how far it is above the strike price, X dollars a share, and that would be incorporated into your option price times 100. Okay, so that would be for if we just do the call. Now let's go back over here and do something else. Let's take a look at what it costs if we were to buy the straddle. So we're going to buy to open again, another option. Now a straddle is when you have the same expiration month, the same strike price, but one's a call and one's a put. Now, why a straddle for this type of trade here? So we looked at the market. We know the trend is bullish. We know the market's just below highs. We have indicators that are also bullish. Doesn't mean the market couldn't take a dive. The major index, the NASDAQ, can start to plummet. Typically, when you have the index take a big move, that also hits stocks like that, at least for a short run. So there's a possible correction. It's on its highs. Why couldn't we have a profit-taking break? That is normal, is to have that expectations. Right now, it doesn't look like it's going to happen anytime soon, but it could. So let's take a look at what it costs for the straddle. So if we were to look at the same strike price, 470, in this case, you would be buying a call and a put. It would cost you $72.30. Now remember, this is times 100. So this would be, it would be $7,225. Okay, so not a cheap position, but once again, you're looking at a stock that costs $470. It would cost you $47,000 plus to buy the stock. And if you buy the stock, you're only good if it goes up. With the straddle, on the other hand, it can go either way. Now think about this. If you put the straddle on, and let's say the market gets down to, let me get rid of this stuff so it gets a little clearer. Let's say that the market falls back to somewhere around here. And let's make it this color with a little dash. Okay, so if the market falls to 437-ish, if you were long the stock, you'd be down money. If you were long the call from 470, it would now be out of the money because the market is below it, which means the value of your call has decreased. So you would be down money if you wanted to liquidate the call, but you still have time, so you're not forced to do so. And if you look at the bulk of trading over the past few months, it's happened in this area of basically 400 up to about 460. So for it to fall in this area here and chop around is totally very, very possible. Remember, when you're looking at options and trading, like right now, we're not looking at a signal. We're looking at trying to capitalize on a company that's dealing with AI. So on that merit alone, you're looking to be long synthetically or outright. We know the outright cost is very intensive. Obviously, when you own the stock, you can own it indefinitely. However, if the market continues to break down, this market's up $200 in 4 months. It could fall $100, and that really wouldn't mean very much, would it? It would actually just take it right just below the bottom of the range that it's been trading in for the past 4 months. So in that case, you'd be risking the equity or opportunity cost by being long the stock. If you were long the call, though, at least that would be better than the stock, because you would take a hit, but you wouldn't lose as much as you would had you been long the stock, as far as when you have your stop level. So we know that those are two ways you could do it, but there's definitely some more inherent risk, especially because the market is on its highs. With the straddle here, you look at this, if it was just to come back to the middle of the range to 437, with the straddle now, your call would be losing money, but your put would be gaining money, okay? So now the thing is here is once you come down to here, what would that mean? That means that time would be the only thing that's really working against you on both options because you bought them. So the value of your spread, you would have till September 29th, that time value is decaying, but that would be happening if you were long a call anyhow. So you have that against you. However, as you are lowering the market's price, that put gains in value. And as that value goes up and gets more valuable than the call price, that's where your profit comes in. So if we look at what was the value here, we know that it's a $7,200. So you're going to need a $70 move for sure. That would at expiration. So at expiration, straddle to break even on would actually be just below here. So if we're at 470, it would basically be right around the stop level right here. So it would have to be right here or lower. Okay, there we go. Oops, sorry about that. Got a little mouse happy there. Okay, so this little, you see this yellow line once again on expiration by September 29th. If your straddle is at this price or lower, you would have the full value of what you paid. So you can't lose any money, especially you're definitely gaining money as it falls below 403. Another good thing is if the market does fall back down here, if it came, its odds are not that strong that if it came back to 403, it's just going to bounce off of that. It could just continue to be a range trade. But since it's been in a bull trend coming off a higher move high, if it was to take out this low, higher move high and a lower move low typically is an indication of a short-term trend change, which would be positive for the straddle. So now we know that of the three different options, what we could do, you could spend $47,000 outright to invest in Nvidia. Okay, or you could get long the call till September 29th and see if the market makes new highs. Now, in that case, let's go to, let me pull up the account summary here. And okay, so here we have the Nvidia here and the price here. Okay, so we don't have right now, there's not much. Market hasn't moved there. Okay. So let's go back to here. So for the price we know that we had was 7,000 for the straddle, just over 3,000 for the call. Now this is the thing you got to think about too, is that for the extra 3,000, it doesn't matter where the market goes. So we looked at, if you still want to participate in the AI, considering where it's at, the third option is the straddle. Okay. Or another thing too is you could do a bull call spread, which would be where we, if we're still bullish, I got to X out these real quick. So this would be where it's a debit spread. So we're going to buy to open. We're going to go to September 29th, and the strike price will be the 470 because that's in the money. In fact, actually, yes, let me see where Nvidia is. NVD days. Okay, so 469. So 470 is still the good strike price there. So we're going to do the 470 call. So you're buying one 470 strike price, September 29th call. And then you're also going to sell to open, same expiration, and now we're going to sell it above this. So we're going to go to a 480. Okay. And this is another call. Okay, so now this is a cheaper way to get long. Okay, so if you look at 470 to 480, if you were to put this is called a bull spread. It's called it's a vertical spread. Now the thing is, when you trade vertical spreads, you want them to typically be in the money if you can or close to it. And here's the reason why, is that when you have an out of the money bull spread, a bull call spread or a bear put spread, they're the same things. It's just a matter of which direction you go in. The last 30 days, you have the sharpest drop off in price. Most of it's because time decay erodes so quickly then. So that's where you got to be careful with this. Now, this one, we are a little bit more, we're right around the 30-day mark. Okay, so for this one, I would say we're going to look at one more month out, just because of the fact that even though it seems like a lot of time for 5 weeks away, in this kind of a situation, it isn't. Now, in this case, we would be selling the 470 strike price, and then the 480, let's beat that blue and give that a 480. Okay. All right. So this is the 480, and whoops, that should be a solid line. Make it a little clearer for you. So this would be the upper one. You're going to be selling the 470 and buying back the 480. So the reason you do this, now it's a debit, because the closer, the 470 is obviously in the money, that has more value. So you're buying that one and you're selling the other one. Now the reason you do that is that you're bullish, but maybe you're thinking like, this market's on its highs. I don't want to get long the stock, and I don't want to buy a call either. Remember what the call cost? So this cost here, it's 4,000, excuse me, it's $4,700, $470. Now, because there's $10 between the lower strike, the 470 and the 480, there's a total of $1,000 of value there between those calls. If it costs you 470, that means there's $530 of money that you can make. So if the market rallies and it goes above $480, you're going to make that $530 no matter what. That's you're locked in on that. But that's all you can make. So you're capped on that. But think about this. The high right now was 481.87. All this market has to do is make a new high, take out that 480, and then you liquidate that spread. Okay, so we have a different opportunity cost here. Let's verify this trade. Once again, this would cost $469 to execute. So 469, let's say 470, at least $530 of profit. So we've looked at 3 ways to get long here. You could, excuse me, 4 ways. You could either buy the call, you could buy the stock, you could put on the bull call spread. That means where you're buying the in the money strike or at the money strike, and then also selling the next strike, or the next $10 or $5, depending on the volatility. In this case, the stock moves a lot. So for it to have a $10 wide range is not very, very much. And you could, on a stock like this, you could go out a little bit further, but then remember, the further out you go, the more of a move you need and the higher risk you have on that. So at this one, you were looking at a 1-to-1 ratio. And if the market was to fall back down, you know that the most you could lose on that position there was the $470. So the cheapest of all the plays, where if you were definitely bullish, would be the vertical bull call spread. Obviously, stock gives you longer term opportunity, but there's also the risk of higher loss, in which you are, who knows what can happen. Especially, the problem is you have weekend risk, and that's something no one ever talks about. For instance, you could buy the stock to, let's say today was Friday, and you bought the stock and it was 470. Something could happen over the weekend and the stock opens up at $300. At least with the options, you know exactly what your risk was, and you can't lose any more than that. With the stock, even if you had to stop in at this $403, it doesn't matter if the stock opens on a Monday morning at 300, you're getting stopped out at 300. So that, or you're getting a margin call. If you had this on margin, that's a whole nother topic. These things could happen. All right, so now we're going to speed through some other stocks here. Let's get to where some other names you know. So Goog, here we go. Now everyone's heard about Google. There's been a lot of news about them lately. Here's a stock that, look at this today. It's trading. It just popped right. Let's see, the high, this high here was 134.07. The high today was to double top. So today we double topped at the high for Google. Very bullish. Here's another thing, the indicator here. If you look at it, you can see where it is about to cross on the bottom here, the MACD. That is a lagging indicator, but it is starting to show that it is oversold and ready for a potential pop. So we have a bullish indicator right now. We also have the trend is your friend. The market has been making higher move high, higher move low, higher move high, higher move low. Today, it almost made a higher move high. Could we have a double top situation going on here? Of course we could. It's very possible. All right, so let's see. We have the high here at 134.07. Okay, so this is going to be our threshold here. All right, so let's put in Google into our trading platform here and see what this would cost. Okay, so we know that right now you are looking at for Google, it would cost you a little over $13,300, so basically $13,400 to buy 100 shares of stock. All right, now let's take a look at Google here. So if the market's trading at 133, we're going to look at the 130 strike price. Okay, so we're going to do this, and we'll just put this here, and we're going to look at the 130 strike. Okay. All right, so we know that 13,400 to get long. Now, one of the reasons Google is an AI stock that most people I think kind of missed in the news. Google purchased or took delivery on their first quantum computer a few weeks ago. For those of you who don't know anything or have not heard about quantum computing, it takes AI to a whole new level. It takes computing and everything to a whole new level. And this is not science fiction. This is science fact. It's been in development and in very minimal use up until recently. And now you have Google, Amazon, and all kinds of other companies that are now purchasing these quantum computers where they're going to have such a leap in an advantage technologically over their competitors and anyone that doesn't have it. If you think AI is something giving them an edge, this boosts AI. It's like putting nitrous into your car to make it go faster. So it's something to pay attention to. And we're going to look at what the pricing is here. So we got a call that we're looking. So we're looking here for the call. So 710, so $7.10. Once again, remember times 100. So for $715. So remember, we can get long this stock for $13,000, or going out to September 29th. Oops. We go to here, to this area here. We could buy the call option. So in that case, the call option would cost us $710. Verify with the cost, $732. That's what the exchange costs. And all right, so what does that mean? So let's say you bought the stock. The trend is your friend. If you were just doing a trade, you would probably have your stop, or you should have your stop right around this low, or slightly below that. The main reason being, could the market bounce right off it? Absolutely. What you don't want to have happen is the market plummets, or especially remember, now you can't, it doesn't matter where your stop is when you have the weekend risk, but during the rest of the week, you definitely want to have it in place. Anything can happen at any time. And also when you look at a stock like Google, we know that there's things that make that stock rally really big. They could be one lawsuit announcement away from getting hit for like $70, $80 in stock price, which probably will only be a blip, but these do occur. So you want to be aware of that. So once again, we know what the price is now for the 130 call, $7. Now for that, we know that since it's already, the market's trading at 133, we have a $7 cost. So basically it has to get above 140. 140 is really not very much of a leap, is it? Okay, well, it is above the screen here. I can't scale it out. Okay. Okay, so for that, as far as the pricing, you do need to make newer move highs to make money on the call. Now, the call will have value, but you have time decay. So if the market is going higher over the next 4 to 5 weeks, as long as it's incrementally growing higher from here, even if it's just a little bit higher, that call is going to have value, because remember, it's already in the money. The strike price is 130. So you're going to have that value no matter what. Like come in expiration, if the market was to expire here at 133.50, your 130 call is going to expire with value. You're going to get money back, but you're only going to get $352. That's what it's worth. Okay. So remember what you paid for it, you know, so, or excuse me, that would be 352 of profit on the of value left. Remember, when an option expires, you lose all of your time value. When it expires, obviously volatility component also disappears, and these are all components that are part of the pricing, which is why it's more expensive the further you go out. Okay, so now let's take a look at the straddle for this one, especially since it's on its highs, and considering the cost of the call price, which is pretty high. Now, that's something you have to look at when it comes to the pricing. Sometimes instead of just buying outright calls and puts, it's better to put on spreads because you have more value there. So let's take a look at what it is if you do the straddle. So once again, this is going to be the same expiration month. It's also going to be the same strike price. Remember, when you do a straddle, you don't care where the market goes as long as it does go. Okay, so this one here is for $996. So basically just shy of $1,000, you can put this straddle on. Okay, now remember that when we first started out this example, we like Google, we're bullish on AI. The indicators are bullish. It's right under its highs. The trend is making higher move highs, higher move lows. This seems like it's a good thing to do. What do we want to look for movement? Remember, we were talking about, just like before, if we take out the lows, this is a similar situation where you're making higher move highs, higher move lows, you keep on trending higher. Once you make that higher move high and then you make a lower move low, or what if today's high is it? What if tomorrow, what if the market settles here or lower and then tomorrow actually goes lower and doesn't take out the high? What if it trends lower for the next couple of weeks? What would that mean? Well, if it trends lower, it's got a very good chance at taking out this low. And if that happens, that's also indicating a short-term change in trend. So even though you're bullish AI and you may be bullish Google, it doesn't mean that it's not time for a little bit of a correction. Okay. Here's another thing. Remember that we're looking at stocks, the two that we've looked at, they're some of the biggest components holding the market up. So while the whole index is being lifted by these stocks because of the value of them and how much, I mean, look at this, you know, Nvidia doubled in price in 5 months. Look at Google here. What is Google up in the same amount of time? We're from 104 to 130. Not even remotely the same thing, up 30%, very, very impressive. But still, when you have stocks like Nvidia and stuff like that, those are lifting the index. And if those start to turn or the index turns, you're going to get a drag on them. So we're kind of running into that toppy area, and the straddle is where it looks like to have the most value here. Okay, so for $996, we know it costs $1,000. Okay, and we have till then. So where does it got to go? Our straddle, we know that no matter what, if it's at 130, it has to expire at either 140 or at 120. Could it get down to 120? Very easy. If we do this, just for, let's look at a little value here. 120, we could easily get down to this 122. If you're looking at for a correction, let's say that our scenario is, anything can happen. We're very bullish, but let's say that we're wrong, that it's time the market's overcooked. It's not necessarily going to go into a bear market, but it's going to go into at least a sideways digestive period. Where would it go to? Well, right now, it's very likely that it could come down to, say, right here, 122.50. What did I say at expiration? You got to be at 120 for to still have the full value of the straddle. Now, if you didn't get all the way down here, you still have almost close to it. So if the market, let's say, only got down to, say, 124, $6, if you were long the call, you'd be out your money come expiration. If you were long the stock, you'd already have been stopped out, so you would have lost the $5 times 100 shares. So there you go, you'd be out $500 there, but you also no longer be in the market. If you had the straddle on, you would have recouped your money, and especially if it got down to the 120 or lower, you would make your money. Or let's say that we're right on the bullish scenario. Google takes off. It touched this high today. What if all of a sudden it breaches that? There may be all kinds of buy stops. It encourages people like Google's making new highs. You never know. We're coming close to the end of the month. You might have some window dressing where everybody jumps on the momentum right before the holiday. Anything can happen. All right, let's look at the next one here. Let's look at IBM. Everyone's familiar with IBM. Here's another one that's been trending higher. Now, I put this up here to try and find out this low that happened recently. Remember, I used this as a Fibonacci technique when I went from this low to this high. Now, there's typically, when you have corrections, traders look for certain areas. One being 50%. It's a very common directional point when you're correcting the market will go to. Does it always happen? Absolutely not. This is a situation where it may not do that. One of the reasons I say that is, here's where the 50% mark is. And if this market is only in a short-term correction, because obviously it's come off of its highs, it isn't a bull market. How low would it go? Well, I would say this area here, somewhere between 135 and 137 would be the extreme for this market to continue lower. However, we have this indicator here, which is starting to show the market's oversold. Remember, they're lagging. The market's already rallying. If this is a bull and is going to be a bull, this is going to be up making new highs before this crosses and confirms it. Okay. Now here's another thing. This level right here, this is the 0.382. When you have the market come down to this area, especially when it really bounces on that point, that's usually very bullish. If the market is in a very strong bull trend, it's not going to come back 50, 60% on a correction from a recent swing high to swing low. Odds are it's only going to pull back about around 30%. That's our 0.382. Another thing going for us here is that we have a buy signal. The same day that it made a low here, oops, right here, this is called a bullish engulfing line. That's bullish. So now we're going to look for our long case scenario. So 139, we're going to look at 140 strike price for a good old IBM. I know nobody likes IBM. I still love it. They just don't deal with anything with retail. They are the computer people's computer people. So, all right, 143, we're going to do an add option. We're going to do a buy to open. We're going to look at the call price. We're going to look at September 29th once again. We're going to go to we have 143, so we're going to look at the 141. Oh, we could actually do the 143 option. See, that's a nice thing. People don't like talk about IBM, but it's still a very liquid market where they have more strike prices. That's something you want to think about too when you're trading options. Obviously, these are big names. They're very liquid. They have a lot of attention. There's lots of strike prices, lots of opportunity. When you get into lesser known stocks, there's less liquidity. So your ability to trade those option strategies on those stocks diminishes because there's not as many strike prices, which means you don't have as many potential opportunities. Not that they don't exist, it's just you don't have as many. Okay, so here we buy to open, 1 September call, 143 strike price, $3.50. That's $350. We're going to verify and buy that. So if we were to buy the stock, we know it would cost us what? That would be $14,317. So $14,000 versus the $350 to get long IBM, and right here at the 140 mark. Now, if this buy signal is good and this was just a correction and this was the higher move low, remember, Mark, a bull trend makes higher move highs, higher move lows. This would be locking in that higher move low. We're looking for it to at least get up to the high here. The high was 146. So let's see, we bought a 130, what was it? The 130, oops, IBM. We bought the 350, there we go. Yes, the 143. The 143, so right at the market here. So we have September 29th out to here is when we have expiration. So if we go and we make new highs here and that would be at 146. Let's say we go to 147. On the call, we'd be up $4 right away. Calls would be up money. If we make new highs, especially if we continue into all the way through expiration, that call would be a nice winner. You would be making the same amount of money on that call as you would had you fronted up the money to buy the $13,000 or $14,000 to buy the stock altogether. Okay, so you're bang for your buck with this scenario. If you were to say, hey, I want to get long IBM, this low looks like it's locked in between the buy signal, the corrective area where the market stopped, and the fact that we also have an indicator turning. These are all positive. Instead of buying the stock, unless you really wanted to have it long term, the call would be a great play because it's relatively cheap. $350 you're looking to basically think about this. You'll be making almost, if it just makes new highs and pops above that and you get out of it, you're looking at 100% return on your money. You wouldn't be making 100% return if you had purchased the stock. Okay, so now here's another one. Let's look at the straddle. So we'll add to open here. We're going to buy to open again. Now this case, remember, straddle is the same strike month, or excuse me, expiration month, and then the same strike price. So 143, but it's a put. Remember, you're buying a put and a call. This would be a debit of $596. So I was going to say it's going to be $600, $604. There we go. So for $604, you could put the straddle on. All right, so where does that have to go? Well, for $600, we know that at expiration, it has to be at the very least at 149, be $6 higher, or it would have to be at 147 or 137. 137 would put it right into this correction zone here. So for a straddle, and this is something too when it comes to possibly rolling trades, if you were very bullish this market, let's say that the market actually takes out the low, we could be still in the form of correction. Right now, the market could be rallying. It could reverse gear and sell off hard over the next week and a half, even 2 weeks down into this area. But I bet you here we would find some really good support. May or may not, who knows? But this would be a good area also if you had a straddle. You'd be already up money. You could get out of that, and then you could either roll into another one being like, ooh, maybe if this was just a correction, we pretty much found the area where it's bottoming. Now we're looking for it to go from, say, 137 up to 148, 150. Then you're looking for like a $10 move. And considering you're in a bull trend with no confirmation of having any reversal of trend, you'd be looking for more of upside potential than downside potential, especially since we already know our downside potential. It's only about $8 lower than where the market's at right now, but we definitely have more to the upside. So for a straddle in this case would be a great call. Now let's also look at, we have the 143 call. Let's do another call, but we're going to do a different strike price. We're going to check out the 143 and we're going to go, let's see, $5 higher. Oh, you know what? We can do a whole 10. Let's go to 150. Hell yeah, let's do the $5 out. Okay, so remember when we did in the last example, we did the vertical spread, the call spread. It's where you're buying the front month call, and then you're going to be selling out the further month. Okay, so in this case, it would cost you $236. And now there's only a difference of $5 in the strike price, but that goes with our example. So for $5, you have a potential to make, this is 235. You're looking at 265 of profit, but you have very minimal risk. It's the cheapest of all the spreads. And if we're right, if the market just gets up to the highs, it doesn't have to break out to huge numbers. 148 is a strike price that it needs to get to. So if it gets up to here, you lock in your money. This is the cheapest one. So for those of you that, let's say you're like, Teddy, I don't know, straddles, getting long calls, just being outright taking a position. I don't want to do that, put that kind of money at risk. I'd rather start out being more conservative and build up my capital. This is where a vertical spread comes into play, because you're looking for a high potential of this move to happen, and that has the lowest upfront costs. So you're looking at a chance to also, that would be a case where you'd be making just more than doubling your money. So on that basis, if you bought the stock, you wouldn't be doubling your money. If you bought the call, in that situation, you'd be close to, or you would be, depending on how high it gets. But with the last example, the cheapest example here, you would be definitely doing it. So let's verify this trade, put this on. $243. So like I said, so 260 or basically $255. So you would be making just more than 100% if you're right on the bullish scenario. Also remember, if you're wrong, 255 is all you would be losing to the downside versus the money you would be losing if you had bought the stock or the other one. Now we have time for one more example. Let's go to, let's see, we're going to Tesla. Tesla, everyone loves Tesla, right? Here's another example of the markets in a bull market. Obviously recently trending lower, making lower move. It made an overall long-term trend higher move low. Is this the low? That's key. Getting back to our Fibonacci and where does markets gravitate to, you're right at the 67 to, or 50% down to 0.618, right in this area. Very good correction zone. If this recent negative bear trend short term is just a correction, right now we probably have found, oops, that's not what I'm looking for. We probably have found a good bottom right here in this little spot right here. If that's the case, we have a chance to catch a nice move leg higher. So let's see, the market was up at 300, the market's at 237. So if we can get back to 300 or somewhere close in the next couple of 5 weeks, that would be a nice trade. So let's see, we'll look at Tesla. Pull this up right here. All right, very expensive stock, $237 a share. We know how much that's going to cost us. Now let's take a look at the calls. We buy to open, once again, quantity 1, September 29th. And for this, we're going to go to, let's see if we can find a 235 or a 230. 235, there we go, 235 strike price call. Okay, now this is where it starts to get expensive, stocks like this. However, Tesla moves in big ranges. Another reason why, if you're going to buy the stock, I would make sure if you're doing it for a trade, have a very valid buy signal. Don't take a counter trend trade, and there's all kinds of rules. I would say be very careful. Unless you're doing it for a long-term investment, then you just buy it and forget about it. But if you're trading it, it's going to be tough. That's where options come into play. But remember, they're very expensive on Tesla also. So for this one, if we were to buy this option right here, 1625, we know it's $1,625 for the option. But if this trend is solid and the long-term trend is good, if you like Tesla, remember our indicator here is looking at oversold, very good correction area. Let's see what we're gonna do it. We'll pull the trigger on this one. So instead of buying the stock for $1,600, you're long this 235 call. Let's put that right here. And change this. 235. Okay, so right here, this is the call. Considering the expense and your risk reward ratio, now remember on this one, only thing risk you have is the price of the option going into September 29th. If the market stays where it's at or goes lower, then you know what? You know what your risk is. If it goes lower and you had the stock, you're getting dinged on that one. That's a tough one. Okay, so we have the 235 here. We know what the cost was on this one. It was pretty expensive. However, we're looking for a move that has the potential to go up to $300. But let's say in that 29 from now till the 29th, even if it does continue to go bullish, that it doesn't make it to where we want it to go in that time frame. Where could it go? Going to the 50% to the 0.618. Also, we look at right here. We're looking at 265. We'll make this the yellow for our target line. So let's just say that this is the beginning of a bear trend. We could still have a correction up to the 265. So for our call, we are in the money right now as it is. So we have a potential probably to make upwards of $30 on this one. Okay, so a $30 move would be a nice move for this option trade. Obviously, it would be fantastic if you own the stock as well. But then you have a lot of risk on there. So let's take a look at what would it cost if we do the straddle on this one. So buy to open September 29th. And we're getting close to the end here, guys. I know we didn't have any questions in the Q&A part, so I'm just going to keep on going with this, finishing out the 235. So I hope the one thing you gain from this is not just the different types of ways of looking at this to trade it, but also trying to find the value. All right, so in this case, 3,000, it's going to be $3,210 for this one. Oops. Okay, what did we not do? Buy to open. Oops, put. There we go. 235. There we go. So 2,854 to put on this spread. Okay, so 2,854, and that would be for the straddle. Now, the good thing is that we're trading, remember the strike price, excuse me, is 235. If we're wrong, for it to break below $212, you're looking at just over a $20 move. That is, or almost a 20, yeah, just over a $20 move. That is not a big deal for the stock. I mean, look at where it was at. It was at 212 for the low. It was at 300 for the high of this last, from the high to the low. Pretty big action. This was from the middle of July until the middle of August, 1 month. So we could have to think about that, $80 of price movement in like 5 weeks. What are we looking at? 5 weeks to go. We could easily have $40 of price movement. $40 one way or the other on the straddle, you're making money on that one. And the good thing is that these options are so high priced that even when they get closer, you're obviously losing time decay. There's a lot of value, okay? Because these stocks have the potential to move so radically, so quickly. Remember, you're looking at a stock that has ranges of, you know, let's look at 3 days ago. The high was 232.13. The low was 220. That's a quiet day in Tesla, having a $12 range. You know, then there's other days, and look at the trends here. In a 5-day trend here, you have a high of 220 or 276 and a low of 240. Another $36 move in just 1, 2, 3, 4 trading sessions. So the ability to hit these moves for these different strategies is another thing you think of too. So when it comes to this one here, you can even do the, real quick, we'll change this to a call, and we'll go this for a 235. We'll go to 245. Remember, if we had the bull, the debit spread too. Now this one here, you could do from 245. Let's see, if all it has to do is get up to this, making basically new highs. So that one there, you'd be in and out of that spread really quick. So even for the more risk averse trader, someone who's newer, if you were to do the bull call spread here, where once again you're buying a 235 call, selling the 245 put, will cost you $2,700. Now you can only make $1,000 total between that area. With this debit, the options are so expensive that you're going to make that 1,000, and that's where you're going to have that value. You're going to have time decay, but you're still going to be able to have value. So in other words, you spent $2,700 on this one, selling it out on that $5 move or so, you should be able to sell it out at probably like around 3,100. I don't think, it may not be 3,200 if it happens within like the next week and a half. After that, you're probably closer to buffering down by 3,100. So, and that's where we have it on that one. We covered a lot of markets, folks. I want to really appreciate your time here. And now I'm going to turn it over to Gina.
Okay, great. Well, thank you so much, Teddy. That was very interesting and informative. And thank you to all of our attendees today for taking the time out of your busy day to join us. So a few reminders before we go. A recording will be available in the next day or so on our YouTube channel. And I did put in the chat box a direct link if you'd like to subscribe. So if you could just take a moment to go to the chat box and click on it so you don't miss any of our videos from Trading Experts. And we do update that very often. So you'll want to subscribe so you don't miss anything. And then also, Teddy, you'll see during the webinar that he used eOption's paper trading platform. So that is free to sign up for if you'd like to test our trading platform. There's so much you can do on it and so many wonderful features. So if you go to eoption.com, you will find a sign up link, and that is free. It takes just a moment to sign up. So if you are new to options trading, or you just want to try some of the strategies that Teddy spoke about, you can test that for risk-free just when you have a moment. So that would be great. And then also, if you just look at the page at eOption, we do charge some of the lowest rates around. It's just 0 for unlimited stock and ETF trades, and options are just 10 cents per contract plus $1.99 per trade. And we also offer so many great features such as Options Play, which is a free trading tool that helps you set up options trades. And that's normally $500 annually if you were to buy it on your own. And it is free for all of our customers when you open an account. And it is, you don't need any minimum to open an account. You could just go and sign up on our website and you can start using all of our free tools right away. We do offer all kinds of good resources on eoption.com. So we encourage you to go and explore and check that out. And if you do go to our YouTube channel, when we post this webinar, we will have a free stock promotion on there. So you want to make sure that you check that the next day or two if you are interested in opening an account with us. And also, if you like this webinar today, we are doing part 2, and that will be on Wednesday, September 27th. So we encourage you to go to our website and sign up for that. If you go to eoption.com, there is a webinars tab, and I also did put that in the chat box a little earlier. So again, thank you so much for your time. We greatly appreciate it, and have a wonderful afternoon. Bye now.